Namaste everybody. This is me Prayas and you are watching Learn with Prayas YouTube channel. Today in this video I'm going to discuss about the bank guarantee. As all of you can see in the screen, I'm going to cover following topics: introduction of bank guarantee, advantages and disadvantages of bank guarantee, parties involved in bank guarantee, process of bank guarantee issuance and claim, and the last one is types of bank guarantee. Now at first, let's start with introduction of bank guarantee. The term bank guarantee consists of two words, that is bank and guarantee. Bank means a financial institution which generally deals with deposit and lending activities, whereas guarantee means to give formal promise or assurance with certainty. Hence, simply we can say that bank guarantee means formal promise or assurance given by financial institution or banks. In a broad view, bank guarantee is a contractual agreement driven by existing laws and regulation between three parties. They are applicant, bank, and beneficiary. Applicant are those who seeks for issuance of bank guarantee, whereas bank are those who issues the bank guarantee. And the last one, beneficiary, are those who accepts the bank guarantee issued by bank. In bank guarantee, bank promises beneficiary to pay debt, liabilities or losses in case applicant fails to do so or breach the contract. Further, it is an irrevocable written document issued to serve specific purpose having specific amount and validity period which cannot be changed or altered without the consent of all three parties after its issuance. Hence, it gives surety for payment to beneficiary for their losses caused by applicant. So, it serves as a collateral for beneficiary against the payment and loss needed to be recovered from applicant. Moreover, bank guarantee is non-funded credit facilities provided by banks, and they secure it by accepting a collateral from applicant in form of cash, real estate, etc. Bank also charges small portion of commission according to the bank guarantee amount, like 0.1% of bank guarantee amount, 0.5% of bank guarantee amount, etc. Now let's understand it by one example. Smart Electronics, let's call it Smart only, wants to purchase 100 units of smart television amounting $1 million from CG Electronics, let's call it CG only. However, Smart does not have enough money to purchase and asks CG for credit period of 120 days. In this case, CG can ask Smart to provide a bank guarantee amounting $1 million with a validity of 120 days. Now, Smart asks his bank to issue the bank guarantee as per the requirement by offering some collateral and paying some commission. Then, bank issues the bank guarantee and notifies the CG. The issued bank guarantee should have following things: specific purpose, that is to purchase 100 units of smart television; specific amount, that is $1 million; specific validity period, that is 120 days from date of issuance. Here, bank promises to pay the amount of $1 million if applicant, that is Smart, fails to pay to the beneficiary, that is CG, within 120 days. Now, CG will accept the bank guarantee and provides 100 units of smart television worth $1 million to Smart Electronics, making it three-party agreement. Hence, we can conclude by saying that bank guarantee is contractual agreement between three parties, applicant, bank and beneficiary, issued with specific amount and validity period to serve a specific purpose, in which bank gives surety to beneficiary for payment of debt, liability or losses in the event that applicant themselves fails to pay or breach the contract between applicant and beneficiary. Now let's talk about advantages of bank guarantee. In bank guarantee, bank promises to pay the losses of beneficiary in case applicant fails to do so. Hence, it will reduce the financial risks for beneficiary and increases the financial credibility in business transaction. Further, it also gives opportunity for the firms or company to expand its business. Generally, seller does not trust new firm or companies. In this case, bank guarantee helps to build a trustworthy relationship and do transaction between them. Moreover, bank also issue bank guarantee with less documentation than other funded credit facilities and charge the nominal bank guarantee commission fee. Talking about the disadvantage of bank guarantee, bank asks for collateral in form of cash, real estate, etc. for issuance of bank guarantee. Generally, without a collateral, bank does not provide a bank guarantee. Further, bank have strict measures or assessment according to the prevailing law and internal policies of bank to provide a bank guarantee. Hence, newly established firm may find it difficult to cope with that. Now we are going to discuss about parties involved in bank guarantee. As I have already said, generally there are three parties involved in bank guarantee. They are applicant, beneficiary and bank. There will be involvement of only one bank in case of local bank guarantee issued in local currency. However, in case of foreign or cross-country bank guarantee, there is an involvement of two banks. They can be known as local bank and foreign or advising bank. Now, the applicant is a bank's customer who can be individual or business entity who seeks for the issuance of bank guarantee by paying commission and offering some kind of collateral to the bank. Whereas local bank, also known as applicant bank, is a financial institution who issues the bank guarantee in favor of beneficiary or foreign or advising bank on behalf of applicant by taking commission and collateral from applicant. Further, they notify the beneficiary in case of local guarantee, and they notify the foreign or advising bank in case of foreign or cross-country guarantee about the issuance of bank guarantee. Now, foreign or advising bank, which is also known as a beneficiaries bank, comes into the picture in case of issuance of foreign currency bank guarantee. They confirm or support a bank guarantee issued by local banks of applicant. Further, they also issue the counter guarantee against the guarantee issued by local bank and notify the beneficiary about the same. Now, beneficiary is the party in whose favor bank issues the bank guarantee for the business transaction or contract between the applicant and themselves. They accept or take the guarantee issued by bank on behalf of applicant. Further, they have special privilege to claim the mentioned BG amount to bank in case applicant fails to do so or breach the contract. Now let's talk about how the bank guarantee is issued. Bank can directly issue the bank guarantee for small amounts. However, if a firm or individual needs large amount of bank guarantee or need bank guarantee in a regular interval like a contractor company, they should have bank guarantee limit in the bank. Hence, at first, applicant gives application to bank for the bank guarantee limit, mentioning the clear purpose for need of VG limit with a proper and required document and by offering collateral to the bank. Now, bank will analyze the applicant's request. The analysis part generally have four things, that is character analysis, collateral analysis, cash flow analysis and purpose analysis. Character analysis means analysis of applicant's nature and history, whereas the collateral analysis means analysis of collateral offered by applicant according to its value and future stability. Now, the cash flow analysis means analysis of financial position of applicant. And the purpose analysis means analysis of validity and justifiability of need of BG limit. After analysis, bank can either approve the BG limit or can reject it. If the BG limit is approved, then bank prepares legal documents and both bank and applicant executes the same. After that, bank implements the BG limit of applicant in system. Now, applicant can ask bank for issuance of bank guarantee according to his need and approved terms and condition. When bank receives the bank guarantee issuance request, they analyze it with its purpose amount, expiry date being within the approved terms. Now, if the bank find applicant's request is genuine and within the approved terms, bank issues the bank guarantee and notify or provide the same to the beneficiary for acceptance. Now let's talk about process of bank guarantee claim. Bank guarantee claim is done by beneficiary in case that applicant fails to pay its debt or breach the contract between themselves. If a beneficiary finds a need of bank guarantee claim, they can do it by providing a claim letter to bank who had issued a bank guarantee. After receiving a bank guarantee claim letter from beneficiary, bank then analyze the validity of claim and notify the same to the applicant for payment of a claim amount within a specific short period according to a prevailing law. Then, if applicant pays the claim amount to beneficiary within the specific period, bank guarantee claim will be retracted by beneficiary. However, if applicant fails to do so, bank will pay the claim amount to beneficiary. Further, bank will recover that amount by disposing the collateral provided by applicant at the time of bank guarantee issuance. Now let's talk about types of bank guarantee. There are various types of bank guarantee which bank issues. However, here I am going to discuss about 5 common and major type of bank guarantee. They are bid bond guarantee, performance bond guarantee, advance payment guarantee, deferral payment guarantee, and the last one is counter guarantee. A bid bond guarantee is generally used in construction related business by contractor for bidding or tender process. The party inviting a tender or project owner asks contractor to provide the bid bond to ensure that the bid will not be withdrawn before tender result. Further, it also assures the project owner that the bidder will undertake the contract if the bid was selected. Moreover, bid bond guarantee will be outstanding till the tender process or result. So it is converted into performance bond upon selection of bid and will be released upon rejection of bid. Hence, bid bond guarantee is the type of guarantee issued by banks for bidding or tender process which assures party inviting tender that the bidder would undertake or manage the contract or construction he has bidded for. For example, the firm A has invited a tender for construction of building having a tender amount 1.5 million and they ask for 1% of tender amount, that is $15,000 upfront as a security in form of cash or bank guarantee for 90 days. Now, if contractor B, C, or D wants to participate in this tender, they can either provide the cash security of $15,000 with bid application, which might not be available or might be costly for the bidders because they can use that money to invest in some other businesses or other projects. Hence, they opt for providing a bid bond guarantee along with the bid application or proposal and ask their respective bank to issue the bid bond amounting $15,000 for 90 days. Now let's talk about performance bond guarantee. Performance bond guarantee is needed for contractor if its bid was selected or accepted by project owners. A performance bond guarantee is issued to honor contractor a job which it bidded for and also gives proceed to work on same. Further, it assures project owner that the work honored to contractor will be completed on stipulated time. So the performance bond value will be the total project value that contractor bidded for and validity period will be the project completion time period. Moreover, it protects the project owner from contractor's failure to perform according to the contractual terms and bank will compensate the any losses arises from act of the contractor. In addition, it may raise the need of advance payment guarantee too. Hence, performance bond guarantee is issued for honoring a particular project or a task to a contractor, along with giving a assurance for successful completion of project or a task within the stipulated time as per the contractual agreement, and compensating the beneficiary in the event of vice versa. For example, let's assume the bid of $1 million made by contractor B from previous example is accepted by Firm A. Now, Firm A will ask contractor B to provide the performance bond guarantee amounting 10% of total project value that A has bidded for, that is 0.1 million as a security. Hence, contractor B will now apply for performance bond guarantee amounting 10% of bid value, that is 0.1 million, to the bank. And after bank issues the performance bond guarantee as per the requirement of contractor B, he submits the performance bond to project owner. Then the performance contract will be signed between project owner and contractor B now can proceed to work on the project. Talking about the advance payment guarantee, it is needed when contractor wants advance from beneficiary or a project owner. It is generally needed for big projects having a large amount value. It protects beneficiary or project owner for the advance payment made by them, as refund of that advance payment is guaranteed by bank if contractor fails to complete the job in specific time mentioned in the contract, or the contractor breached the contract. Hence, advance payment guarantee is issued to provide advance payment needed by contractor for completion of job or a contract, and also to protect the beneficiary for advance payment made by them to the contractor. For example, a contractor B from previous example is now need fund amounting $0.3 million to complete the project. Hence, he has requested the advance payment to Firm A. Now, Firm A will ask contractor B to submit the advance payment guarantee amounting $0.3 million to secure its advance payment fund. Hence, contractor B will approach the bank for advance payment guarantee, and bank issues the same after analysis. Then the guarantee will be submitted to Firm A. After that, advance payment is released by Firm A to contractor B. Deferred payment guarantee is needed when there is a trading of goods or fixed assets in credit period. It provides certain time for the buyer to make payment to the seller for purchased goods or fixed assets. Further, it assures the seller that its credit will be paid within the specific time. In this type of guarantee, bank makes promise to pay all outstanding credit amount made by buyer to seller if buyer, that is applicant, fails to do so on a certain or specific time mentioned in the bank guarantee. Hence, deferred payment guarantee is issued by bank at the request of applicant or a buyer for the purchase of goods or fixed assets from the beneficiary or seller on the term of payment after a specific time, that is in credit period, and to give surety to beneficiary for their payments. For example, Firm A, which is a buyer, is planning to buy a machinery from Firm B, which is a seller, amounting $10 million. However, Firm A does not have enough money to buy. Hence, A will now ask B for the credit period of 90 days. In response to that, B asks A to provide the bank guarantee of $10 million with validity period of 90 days. Hence, A will now approach bank to issue the deferred payment guarantee as per the requirement. After issuance of same, A will submit that guarantee letter to B and takes the ownership of machinery. Now the last topic is counter guarantee. Counter guarantee is needed when a contractor needed to bid or undertake the projects in foreign country. In this type of guarantee, there is an involvement of two banks, that is contractor's local bank and beneficiary's bank, which can be called as a foreign or advising bank. Counter guarantee are issued by beneficiary's bank, that is advising bank, in which beneficiary's bank gives guarantee for the guarantee given by applicant's bank. Hence, counter guarantee means cross-country guarantee which support or advise the guarantee issued by local or applicant's bank in favor of beneficiary. For example, bidder or contractor from Nepal wants to bid on the project of India. Generally, the Indian beneficiary will not accept the guarantee issued by Nepalese bank, whereas the Indian bank will not issue the guarantee on behalf of Nepalese contractor. In this case, now the bidder will approach his local bank, that is Nepalese bank, to issue the guarantee in favor of Indian bank. Then, when the guarantee issued by Nepalese bank is supported by Indian bank, then they issue the counter guarantee on the same and notify the Indian beneficiary. Friends, this is the end of the video. Hope you have learned new things about bank guarantee today. If you like this video, don't forget to hit like and subscribe button for more future content.